The Bank of Canada cut interest rates for the second time in a row this morning. The benchmark rate comes down to 4.5%. Central Bank says that while inflation progress remains pretty good, the pace of price rises is coming down, growth remains weak in Canada relative to population. Unemployment's been rising and per capita output has been flat to down. The governor, Tiff Macklem, signals that more cuts are coming. Now, our guest says he had been considering, or he had thought that the central bank might consider a pause at the September meeting. We're joined now by Charles St-Arnaud, chief economist at Alberta Central, a former Bank of Canada economist. Charles, thanks very much for coming on the show.
Good afternoon.
So we've had two cuts. The next meeting or interest rate announcement is September 4th. Do you think they will announce a pause at that stage?
Well, before this morning, I was thinking that they might want to consider to see what will be the impact of 50 basis points. But with what they said this morning, it's clear that we can expect another cut in September if inflation continues to behave in line with their expectations and in line with the inflation target.
Yeah, so they're on the track of bringing down interest rates, is your feeling?
Yeah, and my feeling is that we'll probably have a cut in September. We might actually have another cut in October and maybe another one in December. I think from this morning, I think the big change from the Bank of Canada is really the focus on the more of a downside risk. Governor Macklem repeatedly said during the press conference that there is a need to provide more support to growth to prevent the output gap from getting bigger. So it kind of signals that they want to gradually move to a more neutral rate, and probably, I would say, kind of more rapidly than what I would initially thought.
The bank does note today, I think we have a graph showing this, that inflation is still above targets in the US, the euro area and Canada. But I guess they don't necessarily need it to get right down to the 2% before they bring interest rates down decisively.
Yeah, well, we have to remember that the Bank of Canada has a target band. So yes, they're aiming for the 2%, and we're still above that 2%, but the inflation target is between 1% and 3%. And at 2.7 in terms of headline inflation, a bit below 2, again, a bit below 3, for core measures, it's in line with what they would like to see. So it kind of opened the door that they can continue to cut rates as long as they're not seeing upside pressure building up in the system.
The governor said that he doesn't think that Canadian and U.S. interest rate policy will diverge too much. Of course, he can't be certain what the Fed is thinking, but I guess his worry would be our dollar would tank if our rates become too low by comparison.
Well, I think we have to be careful there is that what actually will be driving interest rate is not necessarily the actual kind of spread between the two interest rates. It's really how does that change compare to expectation? So I think we're seeing a bit of the Canadian dollar taking a back foot because the market is calibrating its expectation and expecting probably a faster rate cuts in Canada versus the US. So that's where we're going. But a lot of that's a building up of spread is already in the price of the Canadian dollar. So yes, we might see some depreciation, but I think those who expect a massive depreciation because of the divergence are probably reading too much into it.
Now, one point you've been wanting to make is that the neutral rate for inflation is higher than before the pandemic. So the natural rate of inflation in our economy has gone up?
Actually, it's the neutral rate for the policy rate. So We've been used pre-pandemic to have interest rates very low, actually from the decade from the global financial crisis to pre-pandemic. I think the highest policy rate we've had was 1.75%. We're not going back to that era. The Bank of Canada estimates that the neutral rate is probably between, I think, 2.5% and 3%. I think we're probably higher than that. There's a lot of global factors that explain that maybe we're slightly higher, but that means that consumers and businesses need to take that into account, that yes, rate cuts will provide some relief for borrowers, but do not expect a return to the pre-pandemic level. So you still see a lot of those, you should still expect and plan for higher interest rates for the near future.
Because, of course, in the financial crisis of 07, 08, we got used to near zero interest rates. Then they came up a while. They tanked in the weird environment of COVID. But you think people have got to get used to higher borrowing costs, and we got spoiled over a decade.
Yeah, I think the new reality for the neutral rate is probably a Bank of Canada policy rate between 3 and 3.50. So, and that's almost more than double what we've had in the prior decade. So borrowers will really need to readjust their expectations and plan accordingly in terms of how much they can support.
So you think, the Bank of Canada, their benchmark rate will stabilize around 3 to 3.5%?
Yeah, that's my expectation. That's where we'll see the bottom in the current easing cycle will be reached probably in first half of 2025, and will be about 3 to 3.5%.